Well, hello everyone. Don Garman here again, June 2023. It's been a bit of time since we've done a little update, and I'll explain. The last month or so has been a bit of an odyssey, um, and I will share a bit of personal nostalgia for the time period because I've had a couple of really lovely chats with a couple of you who I certainly won't name, but people who actually go back in our practice prior to us having children, Mindy and I having any children. And so over the last month, we've had our oldest graduate from Georgetown. And so we went back there to share, a week's worth of festivities with her and celebrating all her achievements. Came back with a whopper version of COVID, which it was quite clear was running rampant around the graduation festivities of Georgetown University, although the students, I think, are living in bliss of not testing or caring. So that was a full-blown, storm of a flu and knocked me really down hard for a solid week to 10 days. And I was even testing positive well into the second week. And then even still now into the third-ish week, voice is still coming back. And I'm not sure now if I'm in the tsunami of allergies or if this is still the lingering COVID, whatever. I'm starting to feel a lot better. However, throughout all of that, and we had our youngest graduate from high school last week and turn 18. So lots of positive things to celebrate and changes and makes us ever more present of the passage of time and a lot of things to be optimistic about when we look at our kids and how they're prepared for this wacky future that seems to maybe be always the case. The permanent condition of humanity is the future always seems somewhat uncertain because it is by its very definition. And then as the rest of us are, marching through time here, that comes with its own anxieties and fears. And so what I want to update you on from a market perspective and from a strategy perspective is the most important thing about the last month. And I think this was the idea of the last video, was going into earnings season, which we were in the midst of, and then had again some big earnings ahead to look forward to. We've seen a further example of what we'd have to call excellent operational capabilities of the biggest and most pervasive tech companies on the planet, right? These companies have navigated this period of high inflation and these tricky work from home, not work from home, great resignation, return to work, all of these forces that are splashing around underneath, and where they've been able to raise prices they have, and they've been able to preserve profitability for their businesses. So they were able to actually achieve numbers that didn't seem practically achievable a short time ago. And that has provided the underpinning of the market itself and the relative stability we've had at the index level. So if you haven't heard this theme or this idea, it's been pretty commonly discussed on CNBC. That's been a fairly narrow market, and what that means is it's really 7 stocks that represent 90% or so of the returns, and it's the big 7, right? The Googles and the Apples and the Facebooks and the Teslas and the Nvidias and the ones that have kind of captured everybody's current imagination. So many people don't invest really on individual company levels like we do. A lot of people participate through indexes only. And the thing you have to understand about the structure of the markets is what indexes do is they buy the biggest stocks in bigger percentages, the more expensive they get. And that's never a problem until it is. And you come across a year like 2022, and then it can be pretty painful. And so whereas we own some of those in certain percentages, definitely different percentages than the market, but we're always looking for companies underneath that we think are going to be better forward-looking investments. Continuing to pay ever higher prices for something with no bound has been a painful lesson in prior corrections. Certainly in the tech wreck is named for that reason. And the global financial crisis was an example of people getting more and more exposed to real estate the higher it went. And that was, proved to be painful for certain people looking back. So if there is a stock and trade around here, it's that I've said it a million different ways, avoid the bar fights. We don't love to be right in the crowded things with everybody else. And I've referenced this in the past. When the elephants all try to leave at the same time, they create a stampede, and they all try to get out that same small door at the same time, which was an example of some things that happened around 2022. And this year's been kind of a correction of that correction. And certainly everything's still quite a ways down from where it was at its peak, but certainly quite a ways up from where it was at its low. So we're in that fun, in between period. What I'm going to share, and then I'll leave it at this because I can already feel the voice is starting to go, is let's see. What we like to see around here is, if this comes through, and it will be small, is it does not appear to be coming through. Maybe it is. Let's pretend it is. An example of today where the S&P 500 is down almost 0.5%. The NASDAQ is down over 1%, 1.21%. The three key strategies we run are all up on the day. And that's going to relate to this line here, which is the IWM, which is the small cap index. So what we have in our arsenal that is, I think, has been positive over time is the ability to own things that are smaller that hopefully won't be smaller forever. And so as small caps are now starting to catch up, this week's been a great example of how there is horsepower in our strategies, even when the indexes themselves start to flatten out a little bit, which I would personally regard as somewhat positive from where we are. There ought to be a limit to how much earnings multiple you should pay for companies that arguably really aren't growing very fast anymore. And granted, they're ubiquitous and valuable, and some might say invaluable in our lives. But it's still, from a forward-looking and investment perspective, trees don't grow to the sky, and you don't want to just keep paying an infinite amount for everything, because that's just not good fundamental investing. That's not what has been rewarded over longer periods of time. Now we're in this mood to pay 30 times, I think, or 28 times sales for NVIDIA, which is a wonderful, groundbreaking, disruptive GPU technology architecture that we're all going to need and have. But boy, that's a lot to pay for anything at all. So as you can see in the strategies themselves, we continue to populate them with things that represent what we regard as extremely high quality companies where we think we're paying very fair prices. We will avoid the FOMO euphoria of feeling like we have to pack in the same 6 or 7 names as everybody else in the exact same percentages. That makes no sense to me. So I will not be supporting that movement with gusto for sure. And we will continue to chip away. So we'll leave it there. And as always, if you have any questions, please let us know. Thank you for everything. I'm feeling a little bit better and hope to catch up with you all very soon. All right, bye.